Hello everyone, I am Dr. Abida Barvin, Assistant Professor of Commerce, Sadakutulapa College. Now we are going to discuss about a very important topic in financial management, that is capital structure and its importance.
Let's we move to the topic. Capital structure of a company means the composition of long-term sources of fund like equity shares. It also called ordinary shares and it represents the ownership of the company. Although technically all ordinary shares represent ownership, companies may issue different classes of ordinary shares with varying rights. Then the company may structure their capital through preference shares. It also called preferred shares. These shares are a type of shares that gives shareholders a fixed dividend and priority over ordinary shareholders in receiving dividend and in return of capital during liquidation of the company. However, they usually do not carry voting rights. The preference shares are classified into different types based on dividend, convertibility, redeemability and participation. Then the company may also get their capital from issuing of debentures. A debenture is a long-term debt instrument used by companies to borrow money from the public. The debenture holders are creditors of the company and receiving a fixed interest at regular intervals. Unlike shares, debentures do not represent ownership but a loan given to the company. The debentures are classified based on security, convertibility, registration, repayment and transferability. Then the company also get their capital through a bond. A bond is also debt instrument issued by a company, government or financial institutions to raise money from their investors. When you buy a bond, you are lending money to the issuer of a fixed period and in return you get regular interest and repayment of principal at maturity. Bondholders are creditors, not owners of the company. The bonds can be classified based on the issuer, interest, security, repayment and convertibility. Then we are moved to the importance of capital structure. A well-defined capital structure enables a company to raise the requisite fund from various sources of at the lower cost. It maximizes the return to the equity shareholders and the market value of share held by them. A balanced capital structure enables the company to minimize the various business risks by making suitable adjustment in the components of capital structure. A well-diverse capital structure ensures the retention of control over the affairs of the company within the hands of the existing equity shareholders by maintaining a proper balance between voting rights and non-voting right capital. A sound capital structure enables a company to maintain a proper balance between fixed and liquid asset and avoid the various financial and managerial difficulties. A balanced capital structure helps a company eliminate both the state of overcapitalization and undercapitalization. Now we understand capital structure plays a vital role in determining a company's financial strength, flexibility and sustainability. Choosing the right mix of equity shares, preference shares, debentures and bonds helps the business to reduce the risk, maximize value and achieving long-term growth. Thank you.